Hey guys, what's going on? This is Kyle at ProjectionHub, and today I'm going to be talking about how to get an SBA loan for an event center. Now, an event center can mean a lot of different things. That can mean like maybe you have a restaurant, but you also have rentable space, or maybe you have a standalone, wedding venue where you rent out the whole thing for big events, or maybe you've got an event space that's got go-karts and an arcade and rentable party space. So that could be a lot of different things. I'm going to try to hit all of those in this video today. We're going to be covering a lot of things, so this won't be a short video. You can use the chapters down the bottom of the video below to hop to different sections. But we'll go through things like what documents will you need? What type of SBA loan should you consider? Where can you find that SBA lender? And some tips and tricks for improving your chances to get approval. So we're going to talk about a lot. I'll show a lot of resources that are available for you to use. And yeah, so who am I should mention? My name is Kyle. And I was an SBA loan officer for about 7 years. And so I got a chance to work actually with several different event spaces of various shapes and sizes, like I kind of alluded to earlier. So I've got some personal experience on the other side of the table where I would help people review their business plans, review their projections, take them through the loan application process, collect all their documents, pitch them to a loan committee, take them through underwriting, you name it. So really all the stuff I'm going to be talking about today, I've been on that side of the table. And since that, I've been with ProjectionHub, getting to help people write their business plans, help them create their financial projections, and actually prepare those documents for that process. So lots of relevant experience. Hopefully I can share a little bit of that with you today, specifically for an event center. And if at any point you like the video, give it a thumbs up. That really helps us as a fellow small business. You can subscribe to the channel as well. Not all of our content is specifically for, starting an event space. But, getting SBA loans, creating projections, creating business plans, you name it, we're doing a lot of that. So hopefully you'll find something valuable for you. So without further ado, let's go ahead. Oh, and I guess I should mention before I go past this, if you have questions at all, leave comments down below. We're very responsive down there. Or if you feel more comfortable, just contact us directly at support@projectionhub.com. We'll answer you there as well, I promise. So yeah, let's go ahead and jump in. All right, here we are. And I've got pulled up what is going to be our guide through this whole video. So this is our free SBA loan application checklist. You can get your very own copy down in the description below. It might be popping up somewhere, I'm not sure. But we're going to be going through this thing top to bottom because it is going to guide us through basically all of the relevant kind of areas of subject matter to get you kind of prepared for an SBA loan. So you can already see right off the bat, we're going to talk about the types of SBA loans, where to find an SBA lender, what's the process typically look like, documents based upon what type or stage of business you're in, additional documents, some expectations, and I've got some few things that are off screen that I will show you, as well as like I'll demonstrate some of these tools for you, and I'll show you, and I've got some extra notes to give you some tips and tricks along the way as well. So we got a lot ahead of us. Try to move through things quickly. It's probably worth stating we have a lot of videos that are more of a drill down on specific topics. Like for instance, when we get down and talk about business plans, I've got other videos that are 20 or 30 minutes long on how to write an entire business plan for an event space. And so we won't do quite that much of a deep dive when we get to those types of sections, but I will reference those things, give some tips around those, and we'll keep kind of moving along here. So we are going to start at the top here. And first we'll talk about, because a lot of people don't even realize that there are more than one type of SBA loan. Now, maybe you don't even know what SBA stands for. It stands for Small Business Administration. So the SBA is kind of a bureau or department of the United States federal government. And so they take US taxpayer dollars. And a lot of people think what SBA means is like you ask the SBA for money and they give you money. And that's not really how it works. Now, in extreme cases like the PPP lending fiasco and all that kind of stuff, that's different. So that's probably maybe where you first heard of the SBA. It's very different than that. There's a lot of long-standing SBA programs that have been very effective. And essentially the way that they work is, take a bank, for example. If they participate in SBA lending programs, the bank is still going to take you through their process. They're going to lend their own money. But if it qualifies for one of their SBA programs, the SBA is kind of saying to them, like, hey, we will guarantee that if this loan defaults, we'll cover some of your losses up to a certain percentage. And so it can give that lender a little bit more confidence to make a loan that they may not have originally made. So the SBA was meant to encourage lending activity, create additional access to capital, whereas a conventional loan, traditional loans can be very difficult to get for a small business, especially startups. It's very hard to go into a bank and just get a loan. It's not quite like buying a house where your house is your collateral, and there's just a lot more, standardized process there. And so that's really, we could go way into the weeds on how the SBA differs from some of those, but just to kind of give you a little reality there, a lot of it is the SBA just kind of guaranteeing these loans rather than you're actually getting money from the federal government. And so there's a lot of sub programs and different things, and the USDA has loan programs, and there's lots of different things, but we tried to keep this simple to the most common types of SBA loans that you would probably consider and who they work the best for. So first up, we got microloans. I think microloans are like the most underrated SBA loan product. Now, again, thinking about this through the lens of starting an event space, depending upon the scale of your event center or your event space, microloans may or may not be helpful, or why you need funding. Now, if it's going to be a pretty small, so let's say maybe you're going to rent a space and you need to renovate that space to accommodate certain types of events, you may very well need less than $50,000, and that could be really great. Microloans are meant to be really flexible. They're pretty, I would say, attainable for startups, not guaranteeing, but like you have a pretty decent shot at getting them. What makes microlenders really unique is that they're not banks. They're not depository institutions. A lot of times they're nonprofits. A lot of times they're community organizations. They're usually, there's a handful in each state. Usually they lend to several counties or cities. So they're a lot more tapped into the local community. You may not even be aware that they're there, but they're a lot more in touch with the community, and you'll probably find that process and that experience to be a lot more personalized. So their dollar amount doesn't go up super high, and we'll talk a lot about SBA lenders. I mentioned I was an SBA loan officer for 7 years. I worked at an organization that was a microlender, but also did 7A lending and some different things. So I've got some experience there, but it's a really unique thing. Now, if you are obviously going to need a lot more than $50,000, that kind of rules that program out as probably the best option for you. Now, next up is going to be the most common type of SBA loan, a 7A loan. So if you go to a bank to get your SBA loan, you're going to be getting a 7A loan. Now, there's several subsections of a 7A loan. There's community advantage loans, which go up to $350,000. There's express loans, which go up to $500,000. There's lots of different nuances to this, but you don't have to know all those details. In general, if you go and you talk to a bank, they're going to get you fit into the right type of SBA program. If you're talking to a lender, and we'll talk a little bit more about how to make sure you're finding the right lender. But in general, they're going to help you fall into the right program. You don't need to know the exact words for the type. It's more about who do you talk to at the very start. That's going to dictate the rest of the downstream path of what type of SBA loan you get. So you're not going to accidentally go to a 7A lender and end up with a microloan, or when you should have, or vice versa. So yeah, hopefully that's not confusing. But they're going to be very flexible. They go up to 5 million between the various programs. And so, if you're opening up a more substantial thing, that's probably where you're going to fit in the 7A. And then lastly, and this is an option for, an event space, depending upon the scale of what you're trying to do, is a 504 loan. 504 loans are probably the most unique. I would say they're probably the most complex. They're more geared towards longer term fixed rate financing. So talk about larger facilities, land development, long-term equipment. So for example, a 504 project I was familiar with several, years ago it was like a go-kart track, but they also had a restaurant. And then upstairs, it was a big event center that could be space that could be rented for events and banquets and stuff. And so that was financed with the 504 loan. And so, that is kind of in line with what we're talking about here today. And what makes 504 loans unique is that it's a three-way kind of partnership in the loan. So 50% of the loan is the 504 lender, 40% of the loan is a bank doing like a traditional section of that, and then 10% is going to be the owner investing that. So it's kind of you're working with both a bank and a 504 lender, but the 504 lender kind of leads the way and structures that whole thing, which makes it a little unique. So those are going to be the kind of the different buckets. I would say what should drive which one you go to is, first of all, how much money do you need? Because if you need more than 50,000, or not even close to 50,000, the microlenders aren't going to be a great option. And then between 7A and 504, if primarily what you need is to build a space, renovate a space, get big equipment, 504 should be considered. If you're going to need more working capital involved with there and various purchases, then 7A is going to be the right fit. Okay, so those are kind of our three general buckets of SBA. You can see these are links right here. And in this whole document, all of these things that have little icons and underlines, those are links to go to tools and guides and videos and things that are meant to be helpful for you. So you should grab your own copy of this. And next up, or I should have mentioned, these links right here go to the SBA's website where you can read more about those programs, and it gets into things like, typical terms, rates around those, uses of the loan funds, that kind of stuff. Okay, next up is how to find an SBA lender. Now this is kind of a big one, and there's a lot of interpretation in this. This video right here will take you to a video of our founder and owner, Adam, where he talks and gives some tips about how to find an SBA lender. We've got a lot of content around finding SBA lenders, but we're gonna try to do this for the same three buckets again. So because they are all three of these programs are funded a little differently, which means they don't usually show up on the same lists, which means it can be harder to find them all in one place. So first up, we've got two links. We're gonna open up both of them, and we're gonna look at both of them for microlenders. And so not to make a confusing thing even more confusing, but CDFI stands for Certified or Community Development Financial Institution. And so you can see it right there, Community Development Financial Institutions. And so this is a certification given by the US Federal Treasury. And so a CDFI doesn't have to be an SBA microlender, but they could also be both. And so we're gonna talk a little bit about how to find. So there's some overlap between the two. I mean, technically the difference is just because of where they're certified by and how they get funding sources and where they get loan fund sources. That's what differs them. But the lender that I worked for in Indiana called Bankable was a CDFI. It was an SBA microlender, and it was a 7A community advantage lender. So it's kind of got that trifecta. And so, you can find a lot of these in different places, but a lot of them are going to show up on same list. So this finder will help you. You can come in here. I like to go to loan fund and let's say Indiana, which is where I live. And then let's go to micro enterprise, and then I'm going to filter that, and it's going to give me some things here. Now, first thing I'll point out right away is the top one on the list is located in California. So there are a few CDFIs who are multi-state or even national. They are probably not SBA microlenders because those tend to be much smaller footprint. But here you can see we've got a few that are Indiana specific. Like this one I know is more like Central Indiana. Bankable and Anderson is statewide, and you can come here, learn a little bit about them, go to their website, learn some different details about them. Now, if we hop over to the SBA's website for the list of certified SBA microlenders, and again, their main difference is just the funding source they're getting for the programs, the lender themselves. If I go to Indiana and filter that down, we can see we get a list of 4. And here I mentioned right there is Bankable. That's the lender that I worked for. So you can go to their website directly from there. It's got some contact information, but a good resource to find those lenders. Microlenders, if it sounds like an interesting, like if you fit dollar-wise in that section, I would strongly encourage you looking into it. If you need any help finding one, reach out to us. We'll help you identify one. They take a little bit more work just because they don't have as large of footprints, right? And so they might have specialties, like they might specialize in a specific type of lending, and you have to do a little bit more work. But when you find the one that fits for you, your approval chances go way up because it's a much more personalized experience. We're going to skip 7A for a second and just go to 504 because it's going to work very similar to the list I just showed you. SBA website, go to your state, filter it down, and we can see a lot of these are called CDCs, Community Development Corporations. But you can, again, find your list, go to the website, read about the product offerings, get in touch with them, and just talk to them to find those details. Now, 7A is going to be the most common again. By far the most common 7A lender is a bank. Now, banks, again, they have conventional loans where they're lending basically their deposits. harder to get, more strict to get. You know, they've got lines of credit, they've got different things they can offer, but they also facilitate a lot of SBA lending. They have a department dedicated to SBA lending usually. And so we've got two different resources here that I want to show you. We put in parentheses, 1, if you want to find the lenders, and 2, if you want the lenders to find you. Now, a lot of people jump at the second one because, oh, they think this is less work for me. And this is a very good tool. It's facilitated by the SBA. Basically, you put in your information and then it will blast it out to all of the lenders who have their preferences set up in a way that match, basically, that you could be a good applicant for them. And then they can opt in to essentially talk to you. And I think you would opt in, right? So there's some opting in, and then you would connect to each other, and then you would, start that conversation. The lender I worked at received these. We received a lot of them all the time. We didn't always opt into them, but occasionally we did. The warning for this one is if your motivation is because it's less work, because they're going to find you, I wouldn't do this route if your motivation is for less work. Although you'll put your information into blasting it out to a lot of people, you're probably going to have a lot of people reach out to you and say they're interested in talking to you, because lenders love leads. They're never going to say no to a lead, which might start a lot of conversations, which might start a lot of you submitting documents and applications. But it's hard to say how many of those will proceed past a certain point. So it's still going to probably create a lot of work for you, and just be mindful of that. If you're prepared to do that, that's fine. If you prefer the scattershot approach, more power to you. I tend to prefer a more, procured approach. So I like this one. It says, if you want to find the lenders, this will bring you to a tool that we've created. You can gain access to this down in the description below. Set up, I believe, as a free tool. Still, you never know. This video is being recorded now, but in the future, who knows? Maybe that will change. But I'm pretty sure it's free. And we've taken the last few years of publicly available SBA loan data, put it into this nicely formatted tool that you can interact with. And what this will allow us to do is say, I want to go to, let's see what's available for Indiana. There's just less lending activity in Indiana, so you never know how much is going to be here. And oops, maybe there's no loans for Indiana event space. So in the cases where this tool, because again, we're pulling directly from SBA available data, that there's not a specific industry drilled down in that makes sense for you, then we're going to do 2 approaches to this. 1, we're going to make sure our other 2 filters make sense. So 1, we're going to do Indiana. 2, if you're going to be change of ownership, which would be like an acquisition, existing various ones, or startup, loan funds will open business. So let's do startup, because we'll see where that goes. And we're going to start to see this list start to trickle down. Now, if we can get all 3 of these, then we get the most specific lender for our use case. If we can only get 2, then there's going to be more loans represented, but we're going to have to take a more general approach. So between those 2, we can see in Indiana who's lending the most to startups. And we can see Huntington Bank at the top, which that rings true. You can see Bankable, the lender I talked about, is down there as well. Now let's see, based on what's on this list, I'm going to say other is going, probably going to be the most, because that's the catch-all for general ones, right? You can kind of go through the different ones. Equipment rental, fitness and recreational sports centers could be closed, full service restaurants could be closed. So there's many different things that it probably could fall into based upon the speciality of the event space. But let's just say other, right? So in your state, it might be a different fit. You could also, again, take off the industry and go with who's going to be at the top. So between both of these, Huntington is the top in Indiana, First Source Bank, United, Midwest Savings Bank. So if I take off this industry, let's see how this changes. So like First Source is still the top. So in Indiana, those would probably be my first 2 conversations, is Huntington and First Source, because they just generally across the board have the highest SBA approval rating or likelihood. They're doing the most SBA loans for startups in Indiana. So that's where I would start if you don't have that specific industry match like this case. So those are those 2 options. And again, depending upon your state and the information you fill in and whoever's at the top of the list, we might have contacts at that bank. So feel free to let us know if you need any help reaching out and making an introduction there. And let's see, and we already talked about 504, right? So there's a list. So go ahead, use that resource, find your lender, conversation with that lender. If we can be of any help making an introduction, we're happy to help there. All right, let's get in and talk about a typical process. Now, as a quick caveat, before we get into this, the process is going to look different depending upon the type of SBA loan, the type of SBA lender, and your unique situation. So we've tried to include some of the general steps that are going to be involved, and I'll speak to my experience on what our process used to be like, and maybe some expectations you could have around that. But you should expect it to be a little different for every lender. Banks, 7A lenders are probably going to be the most standardized in regards to what documents they want, just how you interface with them, the turnaround time, all that kind of stuff. But it's going to look a little different even between those two. So most generally, every lender is going to start with some sort of lender intake application. That could be on their website. They might require a conversation first. Most generally, especially even like a bank anymore, you're probably not going to go in and just fill one out. That would be an option for you, I'm sure, especially if there's a branch nearby where you're at. But again, going just by whatever bank's closest to you may not line up with which banks are doing the most SBA lending activity. So that's the whole reason why I was showing you that filter is even if you've banked with someone or deposited with someone for 20 years, they may not be the one that's most likely to approve you for that. It doesn't hurt to have a conversation there. And that should be something I should mention is getting an SBA loan does require you not to be able to get a conventional loan. Now for like a startup and that kind of stuff, it's pretty easy to like get declined, whether that's a soft decline or a hard decline for a conventional loan. So you can pursue the SBA. But it's probably worth at least a conversation with your hometown bank or where you've had the best relationship just to explore, how likely they would be. Is this the type of loan they would ever do? And they should be honest with you soon in the process, hopefully, and not require a credit pull or something like that. But anyways, they're going to have an intake application asking general information, maybe even ask you to upload documents, personal financial stuff, but they should have an intake application. Next step, talking with a loan officer. So this is going to be your chance to tell your story, the business story. They're going to ask questions. It's going to be kind of like an interview, and I don't say it to scare you, but it's going to be a back and forth. They're obviously going to be interviewing you, but I would encourage you to interview them. If the lender you're talking to doesn't want to have a live conversation with you, I would probably go somewhere else. I'm all for virtual processes, automating processes. We do a lot of that as well. But when it comes to a really big thing like getting an SBA loan, you're going to want to talk to a loan officer. You're going to want to feel like you have someone in your corner that's guiding you through the process, answering your questions, just because it can get overwhelming sometimes. So talk to the loan officer. They're probably going to outline, based upon what you say for them. If they're a good loan officer, they'll be honest with you. If they feel like it's going to be a stretch, they should be honest with you about just expectations and what to expect around the turnaround time and all the documents you need and all that stuff. Submit all the documentation that they ask for. Once they kind of have what they need in general up front, like you've met all the basic requirements for the documents, which again, we'll talk about in a little bit, they're going to take all that and go through it or submit it to underwriting. They're probably going to have underwriters, maybe they're on site, maybe centralized location if it's a bank. They'll take some time, a few days, a week, 2 weeks, and they're going to go through all your information with kind of like under a microscope. The job of the underwriters is to poke holes in it and make sure, they're assessing it for risk, basically. They'll probably go through a few rounds of questions. Underwriters will propose questions or concerns. The loan officer should bring those back to you. You'll try to answer those or provide a new document or what have you. There will be back and forth. It's kind of impossible to prepare for what the underwriting process will be like. Once you've satisfied underwriting, they will likely move forward to some sort of committee review process. You won't be present for that. That will either be internal or, if they have like a corporate headquarters, they might do it there. But essentially, it's where they're going to make the decision on if they want to make the loan or not. Once that happens, the loan officer should relay that decision to you. If there's contingencies, if there's concerns, if it's a decline, if it's an approval, like it may not just be yes or no. But the SBA lender I worked for, sometimes it would be, we're not comfortable at this amount, but we would be comfortable at this amount, or maybe yes, but we have some contingencies, like we'd like to add a cosigner, Or, I would say it was pretty rare if a loan made it to loan committee that it would just be a hard no, with no follow-up from that. Usually we would try to deliver that news sooner rather than later. So just be prepared for that. Hopefully it's a lender who's wants to be creative and flexible and try to make it work, even if that means asking for hard things from you. Now, this is where things will get a little different from lender to lender and program to program. If you're talking to an SBA microlender, once they make the decision, you'll probably be able to move forward with closing. As long as you agree to their terms, you'll probably be able to close and get the money within a couple of days. If it's a 7A loan, the SBA guaranteed loans, there's going to be some additional steps even after an internal approval. Now, again, without trying to get too far into the weeds with the SBA behind the scenes, the lenders can have what's called delegated authority. That means the SBA has given them the authority to move forward with the loan if they think it fits the SBA's, kind of standards. So they have their internal approval and then they think like, yeah, this matches up with the SBA stands, and they can just move forward with the loan. Even if they do that, there will be some additional SBA documentation you have to fill out and all that stuff before you get to closing. Some lenders do not have delegated authority. That doesn't make them bad lenders. It's just a different type of certification. Or they might have delegated authority but choose not to use it. And that basically would mean that they take what they've packaged up and they send it off to the SBA for the SBA to review it and offer their approval as well. So if the lender chooses to go that route, it will extend the process a little bit just because they're getting the federal government involved in a part of the approval process. That doesn't pose any risks to you. It just takes some time. And again, additional documentation. Once you get through all those hoops, you can close the loan. So microlenders will look a little different from 7A lenders, who will look a little different from 504. 504 lender has two different lenders involved. So you're going to have kind of a jointed, review processes and all that kind of stuff. So that will look a little bit different too. But just in general, it should follow these general steps. And you should have a loan officer kind of assigned to you that can answer all your questions, have hard conversations with you. They should be your person through the process. Now let's get into documents. Okay, so these are going to look different depending upon your situation. So I'm going to go through each of these. Most commonly, I'm assuming you're either going to be starting an event space or potentially an existing one if you're looking to like expand on or add a different room type or that kind of thing. But we'll talk about each of these. So first off, for startups, again, every lender is going to have some form of a lender application. Every lender, no matter what, you're going to have a personal financial statement. This links to the SBA's version of it. You can download it here. It's going to ask various questions about your personal situation, like, assets and your debts and obligations, your income, all kinds of different things like that. You will have to do a personal financial statement, but every lender, I feel like, tends to have their own personal financial statement. So you may have to do this document every time you talk to a lender. I still would encourage you to fill out the SBA's version of it because it just gives you good practice. A lot of people, just going through life and kind of coasting along and maybe don't take the step of like filling out a PFS, might kind of forget all the details that are around their life. So once you do that once, it will be pretty easy to transfer that if you have to do it again. So I would encourage you to just do that ahead of time. You will need, regardless of existing startup or acquisition, personal tax returns, 2 to 3 years. So start now, get those in a PDF format. If you had a tax accountant do those for you, get those lined up so you have access to them. Business plan is a big one for a startup. So when someone is lending to a startup, they are making the decision heavily based upon your personal situation and your plans and your projections. That's really all they have to go off of because there's no business history. So they're doing it based on what they know about the industry, you specifically as a creditworthy borrower and your strength, and then how good and believable do they think that your plan is and your projected financials. So there's a lot of importance on those documents because there's just less proof to go off of. And so This link right here goes to, we have a bunch of free business plan templates, including a free event venue business plan, along with a long video where I go through and give pointers on how to create an event venue business plan that hopefully will get approved for financing. So you can grab your own copy of that. But, you know, I mentioned there's a long video that goes through all that, so I'd encourage you to do that. But you're also going to need financial projections. So your financial projections will be a part of your business plan, but they're actually a whole standalone separate document, and they're very, very important. Now, ProjectionHub kind of specializes in financial projections, so we're obviously going to emphasize that a lot more. But coming from my experience as a loan officer, we would probably read a business plan once or twice. If it was really long, definitely only once. If it wasn't crazy long, then we would reference it a few times. We would look at the financial projections dozens of times. So you really want to make sure your projections are dialed in. I actually have here an example of one of them pulled up. So I should just point this out directly. This link right here will go to our website where we have this library of financial projection templates, including an event center one. Oops, sorry. There's an event and wedding venues. We've got a few variations. As I mentioned, we've got like a arcade venue. There's lots of different ones you can get from that. But let me pull that up again for you. Essentially what this is it's going to create your financial statements for you. So these blue tabs will basically be where you put your information in. So some basic assumptions like, you know, cost of the building if you're buying the building, furniture, if you need to do any construction. Are you planning on having investors? Are you planning on having a loan? We'll do some calculations for you. Your revenue here. My face is kind of in the way, sorry, but just some general assumptions. Your event packages, how many events you plan to have, seasonality, that kind of stuff. Very simple information. Again, you're only inputting in these little blue boxes. Your operating expenses for each month. And then if you plan to have any salaries or like salaried employees. And then it's going to calculate and generate all of these nice charts and graphs and these financial statements for you that your lender is going to need. And so you can grab that if that would be helpful to you. And yeah, I would encourage you to do that. We do have the ability, you know, we have services available to write your business plan and do your projections for you, but I'm certainly not everybody needs to do that. That's the reason why we make templates and videos. And so you can feel empowered to do them on your own, or at least try to do them on your own first. There's no harm in doing that. So you can check those out. Additional documents, you will have to do a credit release form. They're going to do a credit report or credit pull on you. Different lenders are going to pull that at different points in time. Now you can ask your loan officer, you know, if you're concerned about your credit, maybe it's fragile, or maybe it's recovering, or maybe you just don't want to have too many unnecessary pulls. Just ask your loan officer, say, when is a hard credit pull going to happen? And see if they can get a feel for how they feel about the loan before that point. The lender I worked at, we would not do a credit pull until we decided we were interested in taking that loan application to underwriting. Then we would pull it. So if their initial application came in and there were some things that stuck out to us that would make it hard to make the loan, we wouldn't even bother with a hard credit pull to save the applicant from that. Some lenders will automatically do a credit pull right away. So I would encourage you to ask your loan officer if that's something you're worried about. And every lender will have to do that. You'll do a release form probably in the intake application, and that will happen. Government issued ID, you know, driver's license, passport, even if you're a legal permanent resident, there's some different nuances there, but that's still all good. Probably a resume, especially if you don't have a standalone resume, like at least really writing into your business plan, like your experience and that kind of stuff. And then some additional SBA forms. Now there's this additional documents tab, which we'll get down to at the end of this. So that's for startups. Very heavy on the personal stuff, very heavy on your business plan and projections. So let us know if you have any questions or need any help with those resources. Now for existing businesses, not every existing event space or business is going to need projections or a business plan. So we'll put a but on that. You're still gonna have to do the lender application, still gonna have a personal financial statement, still gonna have a personal tax returns. If you're an established business, you'll need to have business tax returns. So depending upon how your business is set up, like if it's an LLC or a sole prop or something like that, your business tax returns might just be a part of your personal tax returns. So you have maybe like a Schedule C, still provide that to the lender for as many years that you have, up to 2 to 3 years or whatever they ask for. You're going to need to have updated financial statements. So each lender will be different in how much they want to see, depending upon trends in the market or the industry. They might want to see more information, but at the very least, a current year-to-date profit and loss statement or income statement, a year-to-date balance sheet. This video goes to a free balance sheet template and a video on how to fill it out. So if you don't have a balance sheet, it'll kind of help you get one created. Now, financial projections. Now, in the parentheses here, you can see if loan is for expansion. So not every lender for an SBA loan, if you're an existing business, is going to require financial projections. For example, maybe you're refinancing something or something like that, or maybe getting like a small line of credit or something along those lines. They may not require financial projections, but let's say you want to add on to the building and it's going to be, you know, a new offering or new type of room you can lend to, or new type of event you're going to add in addition to it. The lender might ask for projections to make sure they want to see how that is going to cash flow with the new business. And, you know, how much are you making and cash flowing for that? And can it afford a loan payment and whatnot? So if you're expanding, or maybe you're opening a second location, all that kind of stuff, that's when the financial projections are going to come in. Potentially a business plan if they want to see more details around it. But if it's an expansion, at the very least, you're going to need projections. An outstanding business debt schedule. So what debts do you owe? Credit release form again, government issued ID. Let's see here. Articles of organization for the business, basic things, licenses and permits. You know, if like you serve food, if your event center has like a restaurant attached to it, that's going to change, you know, obviously some of the licenses and different things you need to include in that. And then lastly, additional SBA forms. Now down to acquisition, we'll go through this one a little bit quicker because this is less common of a scenario, but it's basically a combination of startup and existing businesses. So acquisitions will have the most documents. So yay for you. It's just a lot more stuff you have to collect, but all the same materials. You will need to have a business plan. You will need to have projections. These links right here, because oftentimes in an acquisition, there's just a lot of complexity and moving parts. People want to work with experts on that. So those links will go to our services where we can actually do the projections and the business plan for you if you're interested. But we do have projection template and business plan template for acquisitions as well linked in here. So those are options for you as well. And then very lastly, if you want to do some financial due diligence, you can check this out on some resources and tips to, you know, check to see if this is a good deal. Do the multiples make sense? All that kind of stuff. So you can check on that. And then we'll, as it relates to documents, we'll hit these ones right here. The reason these are kind of sequestered down to the end is because they're going to be very situation specific, depending upon your type of event space, your type of personal situation. So like if you are leasing the space, then they're going to want to see your lease agreement. Let's see here. Proof of insurance that you've got that lined up. You know, event spaces are going to be insurance heavy, right? So you want to make sure that you have that lined up. If you are maybe using, so like maybe you rent the space and you're going to be short on loan collateral and you're pledging a personal vehicle title, a free and clear vehicle towards the loan, then you'll need to have the title for that vehicle. Purchase agreement to buy a business. So if you're doing acquisition, you know, your letter of intent, your purchase agreement that you've signed. Contracts is a good one. This is probably going to be more related to maybe like an existing business. If you have vendor contracts, you should have those included, and acquisition should probably have those included too. Startup, you probably won't have contracts involved unless maybe it's construction related. Franchise agreement probably may not relate in this case. If you have any affiliated, so if you own additional businesses, you're going to have to provide tax returns around those as well, because the lenders are going to want to prove or make sure that those businesses aren't a risk to this new loan. Loan notes, construction contracts, bank statements. So it's all listed in there. Again, those are going to be situation specific. Your lender, to wrap this all up for the documents, your lender is going to tell you exactly what you need. These sections up here, though, are the ones that are going to be like, and no matter what situation or what lender you talk to, you're going to have to collect these. And some of these big ones are just going to take the most time. Lining up your tax returns, making sure you understand your personal financial situation, having a business plan ready, having your projections ready, having your financial statements ready. Those are going to be the big core components that are going to take the most time and energy to put together. So if you at least get those ones ready to go, then all those additional miscellaneous ones are gonna be a little bit easier to collect. Those are gonna be, you know, you're gonna fetch those things rather than having to spend some time thinking and planning about those things. So try to do the big ones up front and then let the loan officer kind of guide you through the rest of those. All right. I want to leave you with some final points of just kind of touching these ones right down here, and then some ones that I've got off screen. Some additional supporting documentation we didn't talk about, and this could have implications for your whole SBA application, is going to be, there are going to be some eligibility issues. I've got this linked right here, but if you have concerns, you should just go out and do some Googling for these. There's types of businesses that can't get SBA loans, and event space is not one of them typically. So you shouldn't be, there shouldn't be like an improper use of funds related to an event space or an event venue or wedding venue that are going to violate that for an SBA loan. But there are some personal ineligibilities as well. Like if you have defaulted on an SBA loan before, or a federal loan before, then that could put you at risk. There are some like criminal related charges that could discredit or disqualify you from an SBA process. To be clear, just because you might have a criminal history or criminal record does not immediately disqualify you from an SBA loan. There are certain types of charges that would disqualify you, but you might have to have documentation around those. If you're engaged in any active lawsuits, that could be an issue. Prior bankruptcy could be an issue. So these are nuanced because they're not all necessarily immediate disqualifiers, but you're probably gonna need to provide more information about them. So just be forthcoming about those things. Okay, some final points here to make. Personal guarantee, you will be required to personally guarantee the loan for all 20% or more owners. If you have multiple owners and nobody owns more than 20%, there will have to be at least one personal guarantor. A lot of people, when I was a lender, would come and say, hey, I want an SBA loan, but I want it to be the business's name and I want to keep the personal businesses separate. It would be great advice if it worked that way. It's really good advice when it comes to bank accounts, bookkeeping, that kind of stuff, but it's unrealistic advice when it comes to getting a loan. You will have to personally guarantee the loan, which means if the business fails to repay the loan, you're on the hook for it personally. And you do not want to default on a federal loan. I'm not trying to scare you away from an SBA loan. Just make sure you understand what you're getting yourself into, that you're going to want to repay it just because of the implications if you don't. Collateral will be expected. A lot of people think SBA means you don't have to have collateral. That's kind of true in that the whole point of the SBA is to help give the lenders some backup that maybe they wouldn't, typically make this loan because it's light on collateral, and the SBA can maybe help get them comfortable with making the loan. The SBA still requires the lender to get as much collateral as possible and to try to fully secure the loan. So if the business itself doesn't have a lot of assets, they're going to ask for personal collateral. So just be prepared for that. For your event space, if you're planning to rent the space, that means you're probably not going to have much collateral. And so they're going to ask for personal things. So free and clear vehicles, a second mortgage on a house, or any sort of real estate. Those are going to probably be the most common ones. I'm not telling you have to do that. Just don't be surprised if they're asking for that. And I would probably be prepared and know what you have to offer or what you're willing to offer before the fact. Owner cash investment of 10 to 20% of the loan request, or it's typically of project request. I just think of the loan request is probably the easiest way to think about it. So let's say you need a $200,000 loan, or $200,000 to get this whole thing off the ground. The lender's not going to give you $200,000. They'll lend, maybe up to 90% of that, but you'll have to come up with, 10% of that at least personally. So you will need to save up some money or locate some funds to make up for that portion. That can be an investment from you. That can be a gift from someone else. It might even be, I think it can even be a loan. That loan just has to be behind the SBA in order to get repaid. Your deal will need to show sufficient cash flow projections based off of historical financials or projections. So this might sound confusing, but they want to see a 1.25 debt service coverage ratio or higher. Essentially that means, and I can bring up the projections here to show you again what this would mean. And that is essentially the lender wants to make sure that there's going to be enough cash flow to not only cover all the costs of the business, but also more than enough pay for the loan payment. So if it's too close, if it's under 1.25 and it's close to 1, that means the business is barely covering what it needs to for the business as well as the loan payment. So that 0.25 gives a little cushion for the loan. They make sure that the loan's not putting too much strain on the business. So they're going to want to see it be higher than that. You know, the projections are what they are, and you want to make sure they're realistic and they're accurate. One way to give a little bit more buffer to your debt service coverage ratio is to not pay yourself out of the business right away. Maybe keep a job if you can on the side as a way to until the business can reasonably compensate you without putting additional strain on the business. That could be a good way to pad that a little bit. So that would be something I would add into that. And we already talked about ineligibility. So before I let you go, I have some general recommendations to improve your approval chances. First one, be prepared. So have as much of the documentation ready to go as possible. We already talked about that. There's going to be items you can't possibly prepare for or know that the lender is going to want, but get these core ones ready. Get your tax returns in order. Get your business plan buttoned up, get your projections buttoned up, get your your financial statements buttoned up. Those are going to be the big ones that are time consumers. So just get all those things at least in order. Your licenses, your permits, your articles of organization, all that kind of stuff. And then beyond that, you know, the lender can let you know what they need. Have the right expectations. We already hit some of these expectations down here. So hopefully those were a little bit of an eye-opener to you just in things to expect for an SBA loan. One that we didn't talk about there is going to be like turnaround times. So, you know, microlenders tend to be pretty fast. If you have everything you need, you might be looking at, I don't know, 2 to 4 weeks. Some special lenders might do it even faster than that. If it gets much faster than that, you might be talking like online lender, high interest rates. So I'd be leery of that. 7A loans, you know, you're probably looking more at like 4 to 8 weeks. 504 are probably going to be in a similar range, maybe even a little bit longer just because you're dealing with buildings and that kind of stuff. So have those expectations. If you are getting all of these things ready in advance, if you're getting everything to the lender as soon as they ask for it quickly, then you reserve the right to ask, you know, for expectations on turnaround time and all that kind of stuff and put pressure on. If they ask for things and it takes you a week or two to turn around those documents and get them back for them, you should expect to wait for a little bit. If they're waiting on you, then you can't say I need to move quickly. So just have those expectations. There are other loans you're working on, but if you have your stuff ready to go, then you should feel like you can ask for updates on turnaround time expectations and whatnot. Find the right lender for you. So we talked about that a little bit in this one, but 2 warnings, which I mentioned. One, your hometown bank may not be the best bank for you. You know, if you go through the filtering process and you find out that your hometown bank doesn't even show up on the list of SBA lenders, then I probably wouldn't talk to them about your project. Unless you want to just have that initial conversation, make sure that it's something that they wouldn't be interested in, and then move on to that list that you find. And then the other thing would be loan brokers. Loan brokers are not all bad. I don't want to give you that impression. Loan brokers are just incentivized to send you to whoever they think has the highest chance of approving you or gives them the best, you know, payout, to be truthful, right? So maybe that sounds great because you just want to get approved, but it may not be the best term for you, it may not be the best relationship for you. So you just need to be open to that. Don't just blindly go where a loan broker would tell you. Make sure you feel comfortable with that lender and their terms and their rates and all that kind of stuff. Share the dirty details early because they will come out eventually. So the lenders have the tools to do background checks and check for, you know, criminal records and all kinds of different things. So just share those things up front. If you have a criminal record, if you have a bankruptcy, if you have any sort of legal court proceedings, if you have damaged credit, you know, if you've got, you know, unrecognized cash, like all those kinds of things, just tell your lender. Sure, it might hurt your chances for approval. I'm not going to tell you it won't, but that's much better than if you hide one of those things or misrepresent one of those things and then end up getting the loan and then the lender finds out, because that puts you at risk to have your loan called immediately, and that could be scary for you. So I would just encourage you, share the dirty details up front to get those out of the way. We already talked about accurate financials and realistic projections. So do the benchmarking, needs to cash flow that debt service coverage ratio. Ditch the long and generic business plan. So I've got other videos that talk about this, but keep it short and sweet. Keep it simple. A lot of people have the urge to put all of their hopes and dreams for what the business could be in their business plan. You should do that if you need to go through that exercise and have your thoughts all down on paper. But the version you give to your lender should be shorter, it should be specific, it should be detailed, and it should only outline what you need in order to get your loan and be successful in the short term. So for example, if you want to, this is an event space, but I'm going to use a trucking business as an example. Say I wanted to start a trucking business and I had plans to try to get to 10 trucks in my fleet by year 5. What I really should do is I should put together my business plan around my first truck and make sure the numbers work for one truck and get the lender comfortable with one. That should be today's goal. My business plan doesn't need to talk about how I want to have 10 trucks in 5 years, because that could change the lender's perspective. They may be overly concerned with that or distracted by that, or want to talk about the projections for 10 trucks in 5 years. So think about that for your event space. Maybe in the short term, you just have whatever your space is and you want to make sure those numbers work, but maybe in the back of your head, you have plans to double the space or add a second location or add new offerings. So only include what you think is necessary to make the numbers work and get the deal to the finish line, rather than complicating it and getting the lender overly concerned about what you plan to do in the future. Hopefully that makes sense there. Strengthen your loan application. So I talked about, can you keep your job for a little bit longer to help with repayment? Personal collateral. Line up a cosigner if you need. If your credit's going to be a concern or your income's going to be a concern, be proactive. Ask someone that has good credit and outside income if they would consider being a cosigner if needed. So that way, when it gets down to it, if your loan officer says, hey, we like this deal, but we're a little uncomfortable, could we have a cosigner added? You say, I've already talked to somebody, let me double check with them, and yeah, let's move forward. That saves you some time if you have that conversation early. And then the last point, make sure that you as the owner or your leadership team has ample and relevant experience. So you know what you're getting yourself into, you know what you're doing, and make sure that's very clear in your business plan and talk about that with your loan officer. All right, and that, I think, covers everything. Again, we've got videos that go into details on the projections. We've got videos that go into detail on the business plan or finding a lender. So grab this checklist, use all the resources in here, but don't hesitate to reach out by leaving a comment on YouTube or emailing us at support@projectionhub.com about how, what questions you have with your SBA journey for your event space. We would love to help you out with that. And give the video a thumbs up. If you made it this far and you appreciate the content, we'd love to hear that back from you. So we wish you the best of luck with your event venue, your wedding venue, your event space, all the different things you want to do for it. And yeah, we wish you the best of luck. Thanks.